Hey everybody, it's Patrick Moore with Ironclad Wealth Management here, and today I've got a more expansive blog than we normally do, a little bit longer of a video because we're going to be talking about a big topic that most people kind of tend to ignore because it's not exciting. Not the best segue into a video, but I thought I'd just kind of let that out up front. Because what we're going to talk about today is how you can protect your family and your small business. Because when you start that small business, as you know, financially, everything's interconnected. If it's personal, it's business, and if it's business, it's personal. And so when you do that, some of those risks commingle. And luckily, there's just kind of some basic steps you can take. Now, full disclosure, this isn't going to cover like company or industry specific risks. This is really just kind of like good housekeeping, the 10 or 11 best things that I think everybody should be aware of. But even with that being said, I think that it's going to be something that's going to be beneficial to almost every small business owner that watches this video. So, with that being said, this is general advice. Please don't take this as individual advice. If you think it's something that might resonate with you, which I hope it is, reach out to your own advisor and see if this is something that you should do. So, with that being said, we're going to talk about a lot of different risks. We're going to identify them. We're actually going to identify the possible solutions you have. And then we're going to kind of tell you, hey, here's what we would do if we were looking at that. So, with that being said, we're going to start with the largest risks that people face. These are going to be things that don't happen very often, but when they do, they severely, severely impact you both on a business and personal level. Now, with that being said, the first one that we're going to talk about is disability. Meaning, okay, hey, I'm unable to work now. What does that mean? And the easiest way that I'd like to think about this for clients, whether you own a business or not, is if you were unable to work, if you did become disabled, would you be able to? And could you retire today? Because if you think about it, when you're disabled, what you're doing is you're retiring early. And so, unless you have a couple of $1 million in an investment account or you've got a business that generates profits for you, you're going to be in a financial burden, kind of a financial tight spot where you could really run out of money. And at the same time, you might have your health costs going up. So, this is just a little chart that shows you just how much, depending on how many years you're working, that lost earnings could turn into. So, as far as the solutions go for disability, there's a few. And I think the biggest thing, and probably the most common misconception, and I think most people kind of understand it now because some of the literature has changed, is health insurance will pay for your medical expenses. But if you're out of work for 2 years, they're not putting a new paycheck in your bank account. So, do not think about health insurance as being a solution. And we'll talk about health insurance in a minute because it does help you with some of the costs, but it's not going to help you if you're unable to work. So, risk one disability, there's 5 solutions that I typically work with business owners on. The first is your business itself. If you can build a business that has enough coming in profits, and most importantly, doesn't rely on you to generate those profits, well, then a disability doesn't matter as much to you because you're still going to have business profits and you can rely on your employees to generate income. And now that's a big if, but if you can pull that off, that's the best solution, right? Because then you're not necessarily worried. The second solution is self insurance, meaning outside assets, IRAs, 401ks, investment accounts. Those are sufficient enough for you to retire early. The third is an individual disability policy, and this is where we kind of move from the world of, hey, we are self insured to, hey, we're not self insured, and what are the solutions? Well, the first solution there is an individual disability policy, which means you're getting it on your own. The second solution is a group disability policy where, hey, if you're owning your own business and you've got 10 employees, you can actually get it with quite a few less than that. But you kind of go as a group and you go get a policy. Individual disability policies can be a little hard to get on the medical side. Like if you have a bad back, they might cover you except for the back. A group disability policy, they're going to cover you with no questions asked, but there are some kind of, parameters. Like if you're disabled in the first year or so, you might not get benefits. And then the fifth one is Social Security, which I think everybody understands why that's on the bottom. There's some rules as far as how long you've had to work. You can estimate your benefits at a link you can find in the blog. But the most significant reason is that you're typically going to have an earnings record that's tied to your Social Security benefits. So you're not going to get more than a couple $1,000s a month in Social Security benefits. So if you're making a couple $100,000 a year, it's going to be a big step down in lifestyle if you're relying on Social Security. So when we think about disability insurance, this is what we're doing. This is the easiest thing. This is the easiest way I can think to even explain it. If you look at this, disability insurance is just hedging your bets. You're basically saying, hey, I'll take some money off the table while I'm healthy so that I got more money there if I'm unhealthy. So if you look at this little matrix here, this is just random numbers I've put together, but they're probably fairly illustrative. If you have a $10,000 disability premium and it replaces up to 60% of your income, which is kind of like the common maximum, if you're healthy without a disability policy, you got all $500,000 you're making. But if you're unhealthy with that, you got nothing coming in. On the flip side, with disability insurance, if you kind of meet all the terms, you do everything right, you got $490,000 coming in on good years, which, hey, that's a bump down, right? That's 2% of your income. But if you're disabled, you get to keep $300,000. So when I look at this and I look at this cost benefit analysis, if I'm thinking, okay, hey, I'm never going to get sick, that's fine, but you don't know what's going to happen. So this is what disability insurance does for you. And until you can live off your business profits or investment assets, right? Because if you can do that, you don't need disability. End of story. You can just kind of not have to worry about it. Until you can do that, you probably need a disability policy that'll get you and your family to the finish line. And furthermore, it's not just about your family, right? It's about your employees too, because if that business can continue to operate while you have income coming in, then they're going to be better off as well. Now, the second risk is the risk of an early death, right? I think there's a lot of other stuff that you're probably unhappy with if you die early, but financially what happens is your income stops, right? It's going to affect your family, it's going to affect your small business. So if we're just looking at this purely, from the side of the people who are left behind, right? When you own and operate a small business, your family has 5 different options. They're going to continue to operate that business, and that leads to the logical question, can they operate that business? The second is they're going to sell that business, which leads to the question of, well, what are they going to get if they sell that business after the owner dies unexpectedly? Probably less than they otherwise would. Third, let's say your spouse is continuing to work and their income is sufficient, right? That's another option. Fourth is just similar to the disability program where, hey, if you can live off your investment assets, great, that's what you'll do. And then fifth is if you can't do any of that, you need life insurance, right? So let's go through how this works, because the first thing you need to do is, before you know whether it's coming from life insurance or it's coming from your assets and what the business sells for, is you need to know how much your family will need in the event you pass away. And whenever I kind of talk with somebody, I feel like I always see it. It's like, oh, hey, I got $1 million life insurance policy. And I always say, okay, well, why? Why do you have a $1 million life insurance policy? And it's probably just because that's what was quoted online. You need to focus on what you're replacing. So if you're making $100,000 and you're 45 years old, well, maybe you need to replace $100,000 for the next 20 years, right? That's just a logical way to look at it. Now, we're not adjusting for taxes. We're not doing anything fancy here. And you can get really into the weeds and the details, but you see how that's different. You're not just saying, hey, my wife's going to get $1 million or my husband's going to get $1 million. You're saying they're going to get $100,000 a year to replace my income. And this is how much insurance I need. It's a simple calculation, a simple formula. So I've got a little table of somebody, okay, they're making $10,000 a month. That's $120,000 a year. If they have 10 years of income left, that means, hey, maybe they're 55, maybe they're 50. If they have 20 years left, maybe they're 40, maybe they're 45, and so on and so forth. And you can see what that amount turns into. So for 10 years of income, 1.1 million. For 30 years of income, 2.7 million. So if you look at this, that's how I think about life insurance. And not life insurance, but how much money your family will need. Where that comes from, I don't care. So let's talk about how we find that solution. And it's a very simple formula. We found how much you need. Then we need to reduce it by how much you already have in assets, right? Because you don't want to overinsure yourself. And then that's how you solve how much insurance is needed. So if we look at this little table here, let's just use those same things. If this person who has $1.1 million of insurance, or not insurance, but how much they need to replace their 10 years of income, they've already got $500,000 saved up. Maybe they only need $621,000 of insurance. However, what if that $500,000 is their business? And there's somebody who thinks it's worth $500,000, but it's really only worth $300,000. Then they might underinsure themselves if they're not realistic and brutally honest with themselves on how much they have available. Plus, if this is a retirement plan, maybe your family needs that retirement plan for once you're 65, and it shouldn't be counted, because if you count it, you're double counting that income, right? So that's the formula that it takes. And you just need to sit down and think through what you need and how much you have today. Now, here's what we would recommend. A, be self-insured, but that's easy to say. It's hard to do when you're, say, 30, 35, 40, even if you're 45, 50. The second is, until you are at that point, you need to fill that gap in, run that formula, and fill that gap in with life insurance. Then you need to speak to a financial planner or life insurance agent to determine the right amount and the right company. Or what you can do is there's a great DIY resource, which I have here. It's the lifehappens.com life insurance needs calculator. Okay. Just go to lifehappens.org. You can run through that same little formula that I just showed you, and you can kind of get educated and mess with the kind of the assumptions and conclusions that it runs to and figure out what works for you. All right. So we talked about the big risks, the income-based risks. The second thing we're going to talk about are asset-based risks. And I think the life insurance disability stuff, there's some nuances with small business owners, but at the end of the day, everybody needs it, right? So nothing's earth-shattering, right? But it's something that still matters. Now, the asset-based risks, and we're going to talk about the business risks as well, are all just as important. And the first thing that happens with an asset-based risk, and the first step you need to take to minimize those risks, is to have a sufficient emergency fund. Now, an emergency fund is just money sitting in a bank account that's there in the event that you need it. And the reason why that's so important is we're talking about your assets, right? Well, if you have an emergency and you don't have enough money, what are you going to do? You're probably going to go take out a high interest rate loan. And if you're paying 10, 12, 15 plus percent on that loan, well, that's a significant financial burden on you moving into the future. So an emergency fund, what it does is, whether you're a business owner or not, it puts you in a position where you have the assets and the confidence and the stability to take risks with the rest of your money. Gives you that confidence to take that business risk, invest in your employees, and open a new branch, right? It lets you take more risks. And when we think about emergency funds, with kind of, think about where you are, the general rule is that if you're a single income earner, you're looking at, income of about 3 times, or, monthly expenses of about 3 times going into your emergency fund. If you're a dual income household, it's 3 times your expenses. If you're a single income household, it's 6 times your expenses. And then finally, we use a number called the sleep well number, okay? And that's something where we're like, okay, hey, well, we know it's not efficient, but psychologically, what we need, psychologically, what we're looking for is like a little bit more. It's $150,000 in this example, but you're like, okay, hey, I know it's not efficient, but this is what I need to take risks with the rest of my money. And if that's something that you look at, then the sleep well number could be something a little bit different, but you definitely need to have some money on hand so you're not living off loans if something happens that kind of negatively impacts you. And unfortunately, you got more risks than not if you're a business owner. Now, when you set this up, you definitely want to put it in a high yield savings account or a brokerage account with a money market account in there. Those typically pay 4 to 4.5% as of right now, which is March of 2025. So for dating purposes, I think it's like 4 to 4.25%. But that's something that you definitely want to do. Now, we talked about disability earlier, right? Which is where your income stops. For health insurance, what happens is that basically protects your assets, like we're talking about. It's a high frequency, lower risk event, unless you don't have health insurance, right? And so what health insurance does is, once again, it makes sure that your emergency fund isn't completely depleted. It makes sure that you're in a position to kind of absorb unexpected shocks. So when you're talking about being a small business owner and looking at health insurance, you've probably lost your W-2 insurance, which means the options you have are your spouse's employer plan, if he or she is still working. It's COBRA insurance for a period of time after you leave your employer. It's a group plan that you set up for your own employees, which a lot of costs there, right? It's an individual plan through the Affordable Care Act or Obamacare. And then it's a non-ACA compliant plan, which means that it has some limitations with regards to the benefits provided. And when we're talking about the solutions for health insurance, I'll just kind of keep it quick, right? There are only 2 solutions that I view as untenable when you're talking about a financial plan, because a financial plan for a small business owner needs to eliminate the unknowns and reduce risk. And the only 2 options that aren't tenable are having no plan at all and having a non-ACA compliant plan, even though it's cheaper. And the reason I say that is they don't cap your annual expenses. When you have a health insurance plan that's ACA compliant, you're going to have a premium, and at the very least, you're going to have a maximum out-of-pocket expense. So if we look at this scenario here, the only thing you need to focus on is that in the no plan scenario, your worst case scenario is an unlimited loss. Whatever that hospital, whatever that bill, whatever that emergency results in, You might have to go to collections. You might have all this debt relief stuff you have to go through, but there's no way to cap what your possible expenses are. And if you're a business owner making good money, you're not going to get much mercy, right? It's going to be a situation where you are on the hook. Now, the second thing is for health insurance that's ACA compliant, you've got your premiums, you add it to your max out of pocket. You got some other stuff, copays that come in there, but that's your worst case scenario, which means that even though those basic premiums may be more expensive than you're willing to pay and stomach, you're going to be better off in those worst case scenarios. So all health insurance is to me is an ability to cap what your maximum costs are when it comes to medical emergencies, which is key. Now, non-ACA compliant plans, I don't love them because they don't cap. They're going to have lifetime and annual maximums. And that's just something I don't think really, matches the need. What we need is certainty. Now, the next one is home and auto insurance, right? This is not exciting, something everybody faces, but it's the most common risk that you probably face. If somebody has an accident at your home, or if you have an accident driving around and you're liable, well, your policy is going to get dinged and you're probably going to get sued. Now, what will happen is your home and auto pays that. And what I typically see with this is I typically see policy limits of 100,000 or 300,000, which I don't love, because to qualify for an umbrella insurance policy, which gives you a higher amount of coverage at a lower rate, you have to have at least $250,000, $500,000 for limits. And all you have to do to get that quoted is ask your homeowners and auto insurance agent what you need to do to get that done. If you do that, you can then get an umbrella policy. So when we're talking about recommendations to reduce the risk here, it's going to be to get enough coverage to qualify for an umbrella policy. Because what an umbrella policy is, it may, sound a little funny. All it does is it kind of shields all the risks, right? It's an umbrella over your assets, where if your home policy gets dinged and it gets maxed out, the umbrella policy kicks in and covers whatever's left over. And the reason this is beneficial is A, it gives higher amounts, and B, it's less expensive on a per thousand basis than home and auto insurance. And what we typically recommend is that you have your non-retirement assets, things that are held in your personal name. We have those insured up to that umbrella policy amount. All right, now, final kind of personal item we have here is estate planning. We talked about life insurance, but if you want to have everything situated and have your plan buttoned up, and this is the process I run through with all of my clients, okay? You need at least 3 documents. That's your will, a power of attorney, and an advanced healthcare directive. That's going to kind of cover all your bases. You definitely want to update it every now and then, but unless you have some complex issues here, which when I'm talking complex, I mean these are a few of them. If you have property in several states, if you have a business that operates in a highly litigious field, like doctors, right? If you're subject to estate tax, if you have a special needs child, or really a child who's going to need support after you're gone and you want to have some very specific kind of, limitations on that, then you may want to throw a trust into the mix. But otherwise, set up a program that has at least those 3 documents and revisit it every 3 years to make sure nothing major has changed. So that's definitely something I think you need to do. Now, some of the business risks that kind of cross over into the personal world, because if you think about it, if something happens to your business, your income's going down, right? These are risks that are specific to owning and operating a business. Now, for business structure, what I'm talking about is kind of, are you an LLC, partnership, S Corp, C Corp, or are you a sole proprietorship? If you start a business and you do it on the side and you never set up an LLC, you never set up a C Corp, you never do anything, and you just make money, you're a sole proprietorship. And that means that you have unlimited personal liability for the claims of the business. And unfortunately, regardless of your best intentions, regardless of how good you are at your job, the reality is you might get sued at some point. And if you're a sole proprietorship and that's the situation, your personal assets are on the hook without limit. If the business has $1 million judgment against it, it means your personal assets have $1 million judgment against it. But luckily, there are several different ways you can set the business up. An LLC, a partnership, an S Corp, a C Corp. The only one that does not limit your liability is if you're the general partner of a partnership. So if we're looking at this, the LLC, S Corp, C Corp options, I can't tell you which one is best because there's a whole lot that goes into that on the tax side. However, if you're just kind of doing a run-of-the-mill business, even if it's something that you don't think is complicated or too big, you need to set something that limits your liability up. Don't worry about the taxes because you can have an LLC that's taxed the same as a sole proprietorship. There's really no benefit to essentially having your entire life on the hook. So that's the first risk from the business side that crosses over extremely easily. Now, the second option is okay, well, if I set up my LLC, for example, and I get sued, what happens? Well, all of the assets within that LLC and your investment in the LLC is at risk, right? Because that's all money in the company. That's money that could be seized. It could have a judgment made against it. So, what do you do to prevent that money from getting taken? And these are the common risks that happen. And this is where business insurance comes in. So, there's going to be several types of risks. This is not an exhaustive list by any stretch of the imagination. But if you look at this, things like an employee falling down on the job, a client suing you for faulty work, a customer injured at your location. There's all different types of insurances out there, and really all you need to do is speak to a property and casualty insurance professional to determine what you need. Um, Having this type of coverage on there is essential and crucial because some clients won't even let you work with them unless they see that certificate of insurance. Okay, so it's something that you definitely need to have put together. And there's just too many varieties and kind of industry specific issues out there. So you need to talk to an insurance agent to kind of get that figured out. Now, the next and kind of interesting risk that you face as a small business owner is if you have partners. If you have partners in the business, the reality is a business divorce can be just as messy as a real divorce. You need to protect yourself by having well designed governing documents to either help you govern a dispute while you're living, or two, if you're disabled or injured or pass away, help govern the transition of your shares to your family. Okay? And there's two main documents that are definite necessities here. And that's an operating agreement or a shareholders agreement, which you're going to have depending on how you incorporate your business or form your business. And then the second is a buy-sell agreement, which sometimes is a piece of the operating agreement, but many times is kind of an afterthought and definitely should not be. Now, an operating agreement, what it does is it just kind of dictates how you manage, how votes are held, how you can transfer your shares, what happens if there's a disagreement, what happens if somebody leaves the partnership, how those shares are repurchased, all of those things, right? And what will happen is if you don't have that agreement, essentially you're just leaving yourself open to the court's interpretation and rulings on the specific circumstances of your situation. So looking at this is something that I definitely think that you should do, and having an up-to-date operating agreement, especially in a partnership that's generating substantial amounts of money, is absolutely key. Now, a buy-sell agreement is different. It's usually a subset of an operating agreement, but it can be a standalone agreement. And what it does is it just governs how, when, and for how much you can sell or otherwise transfer your shares. A buy-sell agreement may say you can't sell your shares without your partner agreeing. Now, if you had a plan to sell them, all of a sudden, if you didn't read the dotted lines, you're subject to your partner's whims. It may also say, hey, the partner has the first right of refusal on your shares if you decide to sell. And not only that, it can dictate for how much and for what type of payments your family receive if you were to pass away. What they'll commonly do is they'll say, if you pass away, hey, I don't want to be in business with your spouse. So if you pass away, I'm going to buy the shares from her, and he or she is legally obligated to sell them to me, even if they want to be involved in the business, even if they think it's worth more. Whatever formula is in that agreement is going to dictate it. So if you don't have a good buy-sell agreement in place, your family is at risk of being underpaid, having deal terms they don't like let's say interest rates today are 6%, and that deal term, just for some reason, maybe it was done when interest rates were really low, and it said it was a 3% interest rate, and it didn't say that it changed with the benchmark. Those are real things that I've seen. So protecting your family here and having an agreement that specifies how things are going to work moving forward is absolutely key. And the reality is this agreement is forgotten. Okay, so it's something that you need to keep an eye on. Now, what I recommend is that when you're working with a partner, at the end of the day, always remember this: a partner today can turn into an adversary tomorrow. It's not how you need to go about living your life, because a partnership's obviously never going to work if that's your attitude. But it does mean that you should take the time to invest in having a real corporate attorney review your agreement and explain to you the clauses and how they work, and you and your partner come to a collaborative decision rather than just going to LegalZoom, typing in words, and signing whatever it prints out. Okay. And no, didn't mean to, throw LegalZoom under the bus there, but it's not about them. It's about the thought that goes into that document, because this could turn into a multi-million-dollar decision over the long term. And it's something that is going to hold effect if, like we talked about earlier, you pass away. All right, now finally, the last risk I want to talk about when it comes to businesses, because we talked about earlier, if you're disabled, if you pass away, well, your income's going to stop unless you have a business that generates profits and income on its own. And that should be your goal at the end of the day. Now, some people like to kind of, hand things on their own, be a solo shop, which that's fine and all well and dandy, right? But if you're talking about protecting yourself and your profits, well, you want to build out a team, right? And you can't have a business that generates profits without a team. Now, what happens though is that means you have less time in the business, and that means you're relying on employees. If one of those employees leaves, then your time may have to go back into the business, or it may not operate on its own any longer. So to preserve the business, you need to incentivize and retain key employees. And we kind of subdivide benefits into what we call mainline benefits and key employee benefits. Now, mainline benefits are things like health insurance, 401ks, disability insurance, vision and dental insurance. These are kind of givens. And the reason I include them in here is that I do think they're things that, even though you don't think about them in terms of your key employees, they're things that may matter. And when they take what they're making with you and they compare it to another employer, they're going to say, oh, wow, his 401k match is better. And then they say, okay, well, is it really worth it? Maybe, maybe not. But you need to be looking at it when you're designing your compensation for key employees. And then if that's not enough, and you've got somebody you're paying $200,000 a year, and you want to keep them with you for 10 years, you can design what are called key employee benefits. What those are is they're designed to benefit and retain only one or two employees. You're not subject to ERISA, which means that there's some tax drawbacks to most of them, but they typically have a few features. You can give stock if you want, you can do cash if you want, but they have clawbacks, meaning if you do a 10-year program and the employee leaves year 3, or if you do a 5-year program and the employee leaves year 3, they may only get a percentage of what was put into the plan, or they may get nothing. Those are all things that you can set up and do. Now, the thing that kind of makes people hesitant to do these, right, is that it has to be sufficient enough to matter. If you have somebody making $200,000 a year and you try and lock them up with a key employee benefit for 10 years, and you're only going to give them $5,000 a year in benefits, you're probably going to insult them, right? It needs to be probably 20+% of their annual compensation to make a difference and move the needle and turn it into something that's going to keep them with you there long term, because, the goal is to put golden handcuffs on them, not just actual handcuffs, right? Because if you try and put actual handcuffs on them, they're not going to be happy with you, and it's probably going to backfire. Now, this is an example of a few different options that are out there, not saying which one's best, which one's worse. Some of the things that you'll need to review when you're talking about this with your own advisors is, hey, what am I giving up? Am I giving up some of the actual earnings of the business? Am I giving up stock? Am I giving, and when do I get tax deductions? Do I get tax deductions now? Do I get tax deductions in the future? And if you look at this little matrix, you can get an idea of, which plans may work for you. And if you look at this and want to, look into it, talk to your advisor and see what works. Now, as far as key employee benefit planning goes, what I would recommend is to make sure your mainline benefits are right first. Keep it simple, right? Then once you figure that out, determine if you want to give up stock or not. The reality is, as a small business owner, almost none of us want to give up stock. Like, that's what we built. That's our company. And so if you want to do it, you can. And if you don't, then you need to set a budget for how much you're willing to set aside, because what you're really doing is you're kind of buying insurance on your time, right? You're buying insurance on that person being there for you in the event that they need to take more control, right? Or in the event that they need to continue doing their job and they're not going to leave you. So you need to decide how much that's going to be, determine how you want the taxes to work. And once you determine that, you can figure out which plan works. And then you basically set up just a significant program to retain those employees. It's not going to be something that's cheap, but it's something that, depending on how your job and how your business works, it might be worth it. Now, I know I've been talking for a while here, so thanks for sticking with me. This is just a quick overview. We've got several blogs and videos on some of these specific steps in greater detail. So, if any of these interested you, take a look at our website, take a look at our channel, try and dig into them a little bit further. And if you have any specific questions you'd like to go over, drop us a line. We'll review it. We'll see what's going on and see how we can help. So, hope you have a good rest of the day. And, till the next time.